Inflation, something that all governments have to keep an eye out on. Too much and you're the next Zimbabwe. No inflation and there's no growth. But keep it at a steady 2% and you have an economical utopia. If you don't, then welcome to the deep dark hole of chaos and economic collapse. Good day, chaps. Welcome back to another video. Today we'll be taking a look at inflation. Inflation is defined by an increase in general price levels. No, not by a certain product like IKEA furniture, but rather everything, to put it plainly. There are many causes to inflation, but it all boils down to an increase in the supply of money. Once again, like most things in economics, this is all because of supply and demand. Money is limited in supply. However, governments can print more money, whether it's to cover up some national debt or pay Fox News to spread good news to everyone. Whatever the reason, the more money you print, the less value the money holds. Why? Well, here's an equation about the value of money. The money value is determined by 1 over P, in which P is the general price level. The analysis for the supply and demand of money is different than in typical goods and products, as money holdings are stocks and goods produced are flows. Now, here is a chart explaining the value of money. On the horizontal axis is the nominal money supply. The difference between nominal and real money supplies is that nominal is measured in terms of money, while real is measured against goods and services. On the vertical axis is the value of money, which is pretty self-explanatory. The letter D on the chart is the demand curve, while the S is the supply. You may notice that on the chart, S is a straight line, while D is curved. S is straight as it represents the existing amount of nominal money balances in circulation. If the central bank increases that supply, S moves towards the right. The demand for the nominal money stock is a downward curve towards the right because people make their decisions based on the real, not nominal, quantity. M on the chart is a conceptual stock of money. We ideally conceive the stock of money as how much liquidity is in the economy. Liquidity is how easily an asset can be converted into cash. As all assets have a different level of liquidity, the measurement of the quantity of liquidity is imperfect. Now, on the vertical axis are more numbers. These represent the general price level relative to the value of the money. First, there's the P0. This is the equilibrium price level if the central bank creates a quantity of money, which is equal to M0. P1 is the price level if the central bank increases the quantity of money, which is M1. Now, as you can see on the chart, P1 is lower than P0 on the y-axis. M1 is also farther down the nominal money stock line than M0, with both of them connected to P1 and P0 respectively. Do you get it now? No? What this shows is that the larger the quantity of money, the lesser the value the money holds. Inflation can be balanced back out with interest rates. Low interest rates will attract people towards spending and spur economic growth. However, if consumer spending increases so much that the demand exceeds supply, then inflation may occur. So, governments must always keep track of inflation to avoid economic collapse. But how do you measure inflation? One of the most frequently used tools for measuring inflation is known as the Consumer Price Index, or CPI. The CPI examines the weighted average of a basket of consumer goods and services. In this basket, there are 8 main categories: food and beverages, housing, apparel, transportation, medical care, recreation, education and communication, and other services. An increase in the average price of a basket of selected goods and services signals inflation. A little bit of inflation is good for the economy, as it promotes growth, so governments try to keep the inflation rate at around 2%. Anyways, moving on, the Bureau of Labor Statistics records about 80,000 items per month for the basket of goods and services by calling or visiting retail stores, Service establishments such as cable providers, rental units, and doctors' offices in order to get the best outlook for the CPI. The formula or equation for calculating the consumer price index for a single item is done by dividing the cost of market basket in a given year by the cost of market basket in the base year. Then you multiply that number by 100. But why 100? Why not 50? Why not 200? Well, if you time traveled back to anywhere between 1982 and 1984 and researched what the index average was at that time, you'd see that it was set to 100. So 100 is a number that is considered the benchmark for calculating the increase in inflation rate, or the middleman, whichever. When the CPI is equal to 100, that means the inflation rate is identical to the one in 1984. If the CPI is 175, for example, then it would indicate a rise in the inflation level of 75% from the base year, which is usually set to 1984, to the given year. Got it? Good. Inflation is mainly classified into three groups: demand pull inflation, cost push inflation, and built-in inflation. Demand pull inflation, as the name suggests, is when aggregate demand in an economy exceeds the aggregate supply. Aggregate demand is just the total demand for all the finished products and services. Aggregate supply would be the total products and services produced. Because supply can't keep up with demand, the price of the products and services increase to equalize it. The second main class of inflation is cost push inflation. Cost push inflation is caused by an increase in the cost of wages and raw materials. An increase in the cost of wages comes from the third class of inflation, built-in inflation. When prices of goods and services increase, laborers will expect their wages to rise as well, so that they can maintain their living costs. This causes a downward spiral, as the prices of the products will have to increase as well, as wages are higher. And now this starts again and again and again. As prices increase, workers demand higher wages. As companies now start to gain less profit, they increase the prices of their products and services. So, you see, it does turn into an endless death loop. But inflation can also be caused by a number of things, such as bad weather conditions, like a hurricane or drought, that causes the supply of something, say crops, to drop. Thus, this drives up the prices. When people have more money in their pockets to spend, they can buy more products. This is the demand pull inflation. As people buy more products, businesses see an opportunity to earn more revenue, and so they raise their prices. Now that businesses raise their prices, the big sums of money that people had isn't worth much anymore. But since businesses are raising their prices, people will want higher wages or salaries, which leads to built-in inflation. Now businesses have to deal with higher costs, and so they raise their prices even more, leading to cost-push inflation. So you see, it's all because of an excess of money. The government must have been pretty messed up and corrupted when they decided to print so much money to cover up their national debt in a declining economy with a significant decrease in exports and outputs. Right? Oh wait, that's Venezuela and Zimbabwe.